When last we left off, we had come through chapter 14, which was a lot about the mortgage concept. And North Carolina, we technically don't use mortgages to collateralize property. We use a what? And the deed of trust has how many parties? Three parties. Can you name for me, Melissa, the parties to the deed of trust? The borrower is known as the what? The trustor or the grantor. The third party that holds title is known as what? The third party that holds title is known as the trustee. Who holds the legal title under the deed of trust?
The trustee. Trustee.
We will start all over. We will start all over. What's that? You got busy for a minute there? Okay, are you better? Who holds the legal title under the deed of trust? The trustee holds the legal title. The grantor or the trustor has what we refer to as what type of title? Equitable title, meaning that as long as you pay according to the deed of trust, you will ultimately get legal title once you pay the underlying debt, right? And then the bank is referred to as the what? Beneficiary. You better get that one right because you've answered it on every problem so far. So finally, you answered it in the correct spot. The beneficiary, of course, is the lender under the deed of trust. By virtue of the fact that we use the deed of trust, North Carolina is what type of state? Are we lien theory or are we title theory? We are title theory in regards to that because we use the deed of trust, which means our foreclosures are going to be judicial or non-judicial. So we mean non-judicial under what clause in the deed of trust? The power of sale clause. The power of sale clause gives the trustee the right to sell the property on the courthouse steps based on a call from the beneficiary. That was chapter 14, right? We kind of put that to bed. Based on that, you might want to go back and study it just a little bit. But having said that, we're moving on to chapter 15. We're introducing loan types and things like that. We weathered through the primary market, which is where you go to get money. We went through the secondary market, the secondary mortgage market, which provides liquidity to the primary market, but you guys are not going to Fannie and Freddie to borrow money, right? You're going to the primary market. Fannie and Freddie buys loans that are created in the primary market. And now we're going to talk about types of mortgage loans. On these, as you're studying, do a compare and contrast. That's the way you study these. Compare, what do they have in common? Contrast, how are they different? In the end, that's really the way you're studying these. Let's talk first about what I mean by a conventional loan. Is everybody with me?
Yes.
Here's what a conventional loan means. A conventional loan is a loan that is not backed by the federal government. Conventional loans are not backed by the federal government. Backed, B-A-C-K-E-D, not backed by the federal government. And the reason, well, I didn't want to use that word specifically because when we get to these other words, you will see the word insured and guaranteed to use for certain type of loans. But yeah, that's what we're talking about, okay? That's what it means by the lender bears all risk. Now let me tell you something that's going to be holy in this class. If you don't put at least 20% down, if you don't make a down payment of at least 20%, you're going to have to pay some type of mortgage insurance. In conventional loans, it's what we refer to as PMI, private mortgage insurance. PMI equals private mortgage insurance. Why does it go to conventional loans? Well, conventional, no, they're not backed by the federal government, so they're private loans. If you don't put 20% down, you're paying private mortgage insurance. What's another way of saying that? You're going to have to pay private mortgage insurance if your loan to value ratio is greater than what? 80%. Do you understand that less than 20% down and greater than 80% LTV mean the same thing? Does that make sense? Okay. Let's talk real quickly about private mortgage insurance. Who does private mortgage insurance insure? The lender. It insures the lender. So think about this logically, and hopefully it won't take you a lot of study time to understand this. Private mortgage insurance. If you are a lender, would you rather loan money to someone who has a big down payment, or would you rather loan it to someone who has a very small down payment? But yeah. Okay. I would rather, if I'm a lender, I'd rather loan to someone who had more money down. And the reason for that is they are much safer. Okay? So when we talk about private mortgage insurance, here's what the bank says. If you don't have much of a down payment, the bank will say this, look, we'll loan you the money, okay? But if you're going to put 5% down instead of 20, you're going to have to pay private mortgage insurance to insure the bank against loss. Well, what do you mean by that? Means if you're foreclosed on and we don't get enough at the foreclosure, then the mortgage insurance will pay us the difference. Okay? The mortgage insurance is designed to make the lender whole. Okay? It doesn't protect the borrower. This is not Aflac. It's not going to pay if you get sick or can't work. It's going to pay the bank in case they have to foreclose on it. Got it? But who's paying? The borrower. Well, I don't want to pay you private mortgage insurance. Fine. Put 20% down and you don't have to. I can't put 20% down. So one or the other. One or the other, guys. This is all I got. Private mortgage insurance, conventional loans. Now let me tell you why this is interesting. When we talk about an insured loan actually sounds like it's a good thing. But when we talk about an insured loan, what's it basically telling you about the borrower? They didn't put 20% down, so they had to buy insurance. Okay? So saying insured loan doesn't make it better than a non-insured loan. It sounds like it would be. Non-insured loan means somebody puts so much money down that they don't need to buy mortgage insurance. Does that make sense? Okay. Let me talk to you real quickly about, let me see if it comes up. No, let's just leave it there for just a moment. Let me talk to you real quickly about the word conforming loan. You know what conventional means. Let me tell you what conforming means. When you hear something called a conventional conforming loan, basically what they're describing is it conforms to underwriting standards set by Fannie Mae and Freddie Mac. A conforming loan complies with standards that are set by Fannie Mae and Freddie Mac. I think I mentioned this last week when we were talking about Fannie and Freddie, but let me remind you again. You say, what's the deal? Why would Fannie and Freddie care? Well, remember, Fannie and Freddie are secondary market institutions, right? They're buying loans that are being created in the primary market. Hey, lenders, before we buy your loans, we want to make sure that they conform to minimal standards. What do you think some of those minimal standards might take into consideration? How about the amount of money you put down? How about the credit scores? Makes sense? How about certain ratios? Things like that. Have you guys ever filled out a loan application to borrow money to buy a house? You filled out a standardized form. Loan applications on federal loans or federally related loans, we all use a similar application because they take the numbers from that application, they plug them into a computer, and that computer basically spits out on the other side, approved or not approved. If it says approved, if you've just gone through underwriting for Fannie and Freddie and it says approved, the lender knows that it's going to be subject to being purchased in the secondary market. So now the lender feels comfortable making the loan because they already have a buyer for that loan. So conventional conforming loans, you just conform to standards that were set by Fannie and Freddie. Does that make sense, the logic behind it?
Yes. Same thing.
Well, there are conventional loans and there are conventional conforming loans. Conventional conforming loans are loans that are going to be sold in the secondary market. There's another category of loans referred to as jumbo loans. Now, there's nothing wrong with a jumbo loan. You might guess from the name that it's a large loan. Conforming standards put a maximum on how much that they are willing to buy. I don't know what that number is today. It's probably like $471,000 or something like that. But having said that, the conforming standards only go so high. Okay. Doesn't make anything wrong with it. It just means it's not appropriate for this pool of loans. This is some of the math. We talked about LTV when we did the math. Y'all okay with that? Determining loan value, blah, blah, blah. Wow, that was quick. We're talking about conventional loans. No participation by an agency of the federal government. You're paying PMI. You understand the concept of conforming. You understand the concept of insured versus non-insured. Is that true?
Yes.
Insured versus non-insured, conforming, and look at me. Did you get all those words that were coming through? Or you just squint to see that? Okay, okay. I saw you squint. I didn't know if you didn't understand what you were looking ahead. So now let's move on to an FHA loan. FHA, Federal Housing Administration, under HUD, Housing and Urban Development. So FHA loans, what if I told you this? What if I told you that FHA loans were created to make home ownership more accessible to more people? FHA loans, the purpose is to make home ownership available to more people. Okay, now let's talk about this. What characteristics of a loan would make it more available to more people? Lower down payment, maybe even lower interest rates. Maybe more relaxed credit scores. Hey, now listen, this doesn't mean your credit score can approach zero, but having said that, it's a little more relaxed than on conventional loans. Lower down payments, more favorable terms, maybe relaxed credit scores. Does that make sense? Okay, let's talk about those lower down payments for just a moment. In a conventional loan, I would love for you to put 20% down, but realistically, I can get you a loan if you put as little as 5% down. In an FHA, I can do you one better than that. You get it, well, about 3.5%. About 3.5% down. There are some subsidy programs that you might do as well that you'll learn about in the field. But the FHA program is typically about 3.5% of what we call the acquisition cost, meaning it allows you to roll some closing costs into it. So think about FHA as being 3.5%, 5% down payment. Lower than conventional, certainly, right? Okay. Now, I want you to notice that first bullet point right there. Actually, it's the first black bullet point. Do you see that? This is actually huge. FHA does not make loans. You're continuing. The FHA is a government insurance program. Jen, what word are you underlining? It's a government what? Insurance program. The government does not provide the money for the loans. Well, if the government doesn't provide money for the loans, where do you go if you want to get an FHA loan?
Bank.
Go to the bank, go to a mortgage banker, mortgage broker, go to a commercial bank. The same places you would go to get a conventional loan, right? So remember, compare and contrast. You want a conventional loan, you want an FHA loan, you could probably get them at the same lender. The lenders do have to be FHA qualified, but clearly most lenders are FHA qualified. Make sense? All right, now let's see how this conversation is going to go. Hey, Mr. Banker, I want to borrow some money. Will you have a big down payment? No. Do you have 5% down for a commitment? No. I only have 3.5% down. And I have a more relaxed credit score. Now, why would lenders be willing to loan money to someone that had only 3.5% down and had a more relaxed credit score? Why would a lender be willing to loan them money? How about if the federal government stands behind that person and says, lender, we will insure you against loss if you will loan to this party under this program. Now remember, the borrower has to meet certain qualifications, right? Obviously they have to have income. They have to have at least a minimum credit score, usually somewhere in the low to mid 600s or somewhere in that. I mean, they have to have somewhere with them. Just probably not strong enough to get a good conventional loan, okay? And so now the lender looks at it and says, hey, if the government is going to insure me against loss, I really don't have a lot to lose by loaning money to this particular party. So the FHA program is a government what? Insurance program. This is not the place to be using words that you believe to be synonymous, okay? The FHA program is an insurance program. It's backed by the federal government. The government insures it. Now let me ask you this question. You already know, let me ask you a tough question. You already know if you need money under an FHA program, you go to where to get it? You go to the bank, you go to an FHA qualified lender, right? Where'd the lender get the money? From the secondary mortgage market. Yeah, buying and selling loans in the secondary market. That's what they did. The lender created it, they sold it in the secondary market so they got liquidity so they could sell it again. Aaron, I'm going to pick on you. That's exactly the thing I was trying to trick you into saying. It doesn't come from the government. It comes from the same place that other loans come from, okay? Secondary market, I typically, okay? FHA is an insurance program. Bank says if the government's insuring you, I feel pretty good about you. Where does the money come from that runs the program now? Not for loans. Where does the money come from that runs the insurance part of the program? The borrowers. The borrowers. Every borrower that is in the FHA program pays what is known as an MIP, a mortgage insurance premium. Hey, don't you like the way that with conventional it was PMI, but with FHA it's MIP? We just take the same letters and mix them up. Okay? Mortgage insurance premium. Every borrower, this is not so much a taxpayer-supported program. Every borrower that's in the program pays into it for the insurance. I mean, think about it. Only 1 out of 20 are going to be foreclosed. So that money is used when someone defaults to make the bank whole. And what I mean by making the bank whole, I mean, think about this. If you borrowed $120,000 and the bank went out and sold your property, well, the fact of the matter is they can get 100 for it, right? Or 90. They can get something for the property. So the insurance program only has to cover the difference between what was received at a foreclosure sale and the amount that was owed to the bank. Okay?
What happens at like a time where the economy was in a large downturn and these loans typically being foreclosed, and then would that cover?
See if you can figure this out. Her question is, what happens when we have a situation like we did in the mid-2000s, where we had a lot of foreclosures, a lot of FHA people were being foreclosed on? What's going to happen in that case? Anybody have any idea? Clearly they did. Clearly they did step in this case. But it also affected mortgage insurance premiums, didn't it? Yeah, it affected mortgage insurance premiums. And the reason it did is because the program became more costly to insure. One of the changes, you're not tested on this, one of the changes that they made in the mortgage insurance program is that you used to, if you have an FHA loan, you used to have to pay mortgage insurance, but it would drop off when you got at an 80% loan to value position, okay? But now, if you're under an FHA program, you will have to pay MIP forever.
Okay, so it's not one time payment.
Yeah, you see, sometimes you pay some up front, and then you also pay a monthly as well.
Okay.
But having said that, the current program, you're in it forever. What's the government trying to encourage people to do? Say again?
20% down.
Well, not only that, I mean, that would be ideal, but it's unrealistic. But what they'd love for you to do at some point is refinance out of that FHA program. The idea is that we're going to keep charging you this mortgage insurance premium, because what we really want to do, at one point, I think 50% of the loans that were being made were FHA loans. Understand that it was never designed to be 50% of our mortgage market. It was designed to only be a small part of the mortgage market. But after the meltdown, sometimes the government does have to step in and try to make things available that normally would not be the case.
So you can refinance the FHA loan and go to a conventional loan, is that what you're saying?
Yeah, you can clearly do that. And then another thing that you could do is, oftentimes people that are in FHA programs probably are first or second time home buyers. So there's a real good chance they're just going to sell the house anyway, pay off the loan, then their next
And then they'll have a
loan.
down payment.
Hopefully so, because if you stay in this program, you're going to have to pay that mortgage insurance premium.
You mentioned no income loans last week.
Yeah.
Are those FHA loans?
No, those are not insured. Those are what we refer to as subprime loans. And subprime, by the name, you might be able to figure this out. This loan right here is insured by the federal government. Conventional, remember, most of those are going to be conforming loans. And then you had this category called subprime mortgages. Those were designed for people that didn't fit into A paper, and so they were B, C, or D paper. B, C, D, the more risky, okay? And in those ninja loans, literally, it was basically just backed by the property, because I don't even know if you have income or not. And so it's only backed by the property. If you stop paying me, I'm going to go foreclose on the property and try to get my money back that way. That was a separate section of loans, okay? Yeah, I'm sorry.
For PMI, once you pay off that, your 20% to conventional loan, if you go to 20%, does that automatically get rid of PMI?
Karen just reminded me, I did not bring this up during the PMI, but on the conventional loan, you can drop your PMI in a conventional loan. It's actually when you hit 78%. When you hit 78% loan to value, it will actually fall off. FHA doesn't do that anymore, but conventional loans still do. And how do I know when you're at 78%? Well, you know how much money you borrowed, right? And if you look on your amortization schedule, there will be a spot on the amortization schedule where you have paid off 22%, so to speak. It'll automatically drop off at that point, Karen, if you're paying PMI. Karen, could you refinance before then though, and maybe get out of the PMI, possibly? Could you maybe get an appraisal done and prove to the bank that your house is going up in value and drop your PMI, possibly?
Is that automatic or do you have to request that?
The 78% is automatic, okay? But if you want to try to do it in one of those other forms, you would have to do something proactive. Okay? Yes, sir.
So, there's so many numbers in this chapter, like percentages and stuff, I just have to remember.
Just go ahead and memorize all of them, and then you want to.
Like 3.5% is all I remember.
You don't need to remember. But do you remember this, Ann? Do you remember that FHA allows for a smaller down payment than a conventional loan? That's what I want you to remember. Okay? So far. All right. FHA, lower down payment, relaxed credit, federal government, it's an insurance program. Where do you go to get the money? You go to the same banks that you would go to get a conventional loan, and they quote you the rates, the whole the whole 9 yards, just like you're getting a conventional loan. I apologize. I had no idea what time it was. That's why y'all were starting to squirm a little bit. Normally, the person who sits in front alerts me when I pass 12:30, so make sure you do that. All right, let's stop for right now. When we come back, we'll finish up FHA loans. We will go right into